Hey everybody, Dave here, Hidden Freedom, and welcome back to another video. In this video, we're going to go ahead and talk about an interesting strategy using JEPI and JEPQ. Let's not waste any time. Let's go ahead and get started. Alright, so I've had this strategy in my head for quite a while, and it can actually be used for quite a different things. It's not just for JEPI or JEPQ. I'll use a couple examples in this video to give you an idea of what I'm talking about. Let's go over and look at the portfolio right quick here, because I just want to show you what I'm invested in here. So I'm invested in a little bit of JEPI, right? So $73,000 in JEPI with over 1,300 shares, and then SPY there. I have over 3,085 shares of SPY at the moment, of a value over $1.5 million. So, all right. So the reason why I bring that up is just to obviously I'm invested in the greater S&P 500, which is the overall market, I would call it, right? Obviously you got some other stuff out there like VTI, for example. There's also VT, for example, both from Vanguard. So, but I just consider the S&P 500 kind of the overall market, right? The the 500 biggest companies in the United States. So if I'm trying to beat the market, so I never underperform nor do I ever overperform, correct? So if I want to beat the market, this is one strategy that you could use to actually beat the market. All right, let's go ahead and move on here. And we got a charting here. So I got JEPI populated there, and I got JEPQ populated there. And then I got the starting month is May, and the starting day is May 5th. And I got a starting year of 2022. And then ending date is, I could probably do, let's just do the 24th in there. So, all right, because today's technically hasn't got posted to Google Sheets yet, so we'll put the 24th as yesterday. So, and that's for basically closing day of yesterday. So the reason why I put May 5th there and is right around when JEPQ came out. So any data before that, JEPQ doesn't exist. So that's the reason why I put the start date as May 5th. So one of the strategies I was looking at is how can I take advantage of market declines, right? And now this is not always going to be the case, but this is a good example in 2022 where it could have been very fruitful for you had you followed the strategy. The strategy is not going to work every time. You know, when the strategy works, you can see the reason why it would be a useful strategy. Pretty much, you know, the start of, well, about May 5th going on here to roughly 824 right there, you know, pretty much traded pretty equally, right? JEPI and JEPQ. And we should just mention that JEPI follows the S&P 500, right? It's based off the S&P 500, right? There's quite a few stocks in there that are S&P 500 like, right? And then you got JEPQ there, which is loosely based off of the QQQ, right? Which is the NASDAQ. So what we can do is, you know, how tech sold off a lot in 2022 and then early part of 2023, and you can see that here, big decline right there in 2022, and it wasn't until January of 2023 when things started to improve a little bit. But you can see the big divergence there between the two ETFs, right? You got JEPI up here, you got JEPQ down here, and the wider these get, the bigger decline, the bigger the divergence between the two. We're showing over 23% decline here in JEPQ, and up here, you know, it would show a decline in JEPI of roughly about 6%. So the wider the gap between the two, the bigger advantage that we have. So, you know, you might be saying, well, how do you take advantage of that? Well, if you're investing, say, $750,000 into JEPI, and if you have $500,000 into, say, JEPQ, then what you can do is sell a bunch of JEPI and throw it into JEPQ, and then you ride it up, right? So the bigger the divergence between the two, the bigger the decline in JEPQ, which really means that the NASDAQ is having issues. Then you sell a bunch of JEPI and throw it into JEPQ, and then you ride it up. So in this case here, we ride it up as long as we want to, really, preferably when JEPQ would surpass JEPE, because it really should, and in most cases it really should, just because the NASDAQ tends to outperform JEPE, right? So the NASDAQ just tends to outperform SPY, I guess is a better way of saying it. But JEPQ, being based off the NASDAQ, is going to be a lot more volatile than JEPE is, so that's the reason why we had a bigger decline. NASDAQ just had an issue in 2022 and part of 2023. That is where this strategy would have really worked well. When these little declines like this happen, it's pretty much a broad market decline. If they both decline in a similar way like this, it doesn't make any sense to use this strategy at all, right? But you can see when the NASDAQ recovered, so started pulling away from JEPE in this case here, it would be a good time to actually sell out of JEPQ and then put it back into JEPE. And the reason why you would do that is during a market decline, most likely JEPE is going to hold up better than JEPQ. So you want to be positioned for a market pullback for that reason. So this works with more than just, JEPE and JEPQ. Let me show you another example here. So we got SPY and we got QQQ, and we can just go back to the beginning of the year of 2022. So here's another example here where had you just got out of SPY sometime in late 2022 when the divergence is very big, right? And then dump that money into QQQ, and then you ride it up until it gets equal, if not until it surpasses it. For me, I'd probably ride it out until it goes equal, right? And then I would just put the money back into SPY. I'd sell out of part of QQQ, and then put it back into SPY is probably what I would do. Obviously, this would work the best in some sort of tax advantaged account like a IRA or a Solar 401k or something like that, right? It works with other funds like VGT, for example, and VU. Those are both Vanguard. So we got Vanguard Technology Fund, and then we got the Vanguard, which is SP 500 based VU. And you can see the divergence looks exactly the same, or pretty much the same, right? So, and it works with just more than that too, right? If DIA is a good example, what if we wanted to do the Dow Jones and we wanted to do QQQ? If you had money in the Dow Jones, look at the big divergence there between QQQ and DIA. So you could use this if you had 3 funds. You can throw. What I could probably do is actually throw a third one in here and then do a conversion. Do the analysis on 3 funds, which I'll probably do in an upcoming video. The data is sitting over here, the raw data itself. But, you could use a 3-fund strategy if you're invested that way, right? You have a portion of money in QQQs, you have a portion of money in DIA, you have a portion of money in SPY, for example. Now, maybe you don't use those because the expense rate is a little bit higher in those. You could use the Vanguard equivalents, right? And what I'm probably going to end up doing is I'm probably just going to actually set an alert up with Google Sheets. And then when it looks for the divergence, every single day it just looks for the divergence and then it alerts me or something like that. Or you can even do this actually in Seeking Alpha. I don't know if you can do an alert in Seeking Alpha, but this has been a strategy that's been, back in my head for quite a while. And it just, in 2022, it would have worked very well for you had you followed this strategy. I did not do it in 2022 because of the hike of the Appalachian Trail in 2022, especially during this time right here. Had I known about it in 2022 and I wasn't hiking the trail, I would have probably taken advantage of this. Probably would have stuck some money into TQQQ, actually. It's probably what I would have done. So this is one strategy that you can use to outperform the market. It doesn't work all the time, right? If we want to go back even further or something like that, it's just looking back here. Look at it. You got a divergence there, but you really want to get the divergence on the downside if you can, right? There's a pretty good divergence there. The further they get apart from each other, then that means that, DIA held up very well during this sell-off, and for some reason tech sold off, right? If DIA sold off and for some reason SPY held up or QQQ held up, then you could move some funds around between those three, right? And you're eventually you're going to outperform the overall market, right? So this is just one strategy that you can use to outperform the market, because if you're just in SPY like I am, you're always going to underperform. You're always going to overperform. You're just going to be mediocre and perform whatever the market gives you. This has always been something I've wanted to do, and I just never really set my accounts up to do that. So I think I'm going to, kind of move some funds around, probably in some of the retirement accounts, right? Because I have quite a few different accounts here. I got a brokerage account there, but I don't want to be selling stuff in this account, because you're obviously going to have to take, a capital gain when you sell out of SPY just to put money into QQQ. If you sell QQQ as things, come up in QQQ, then you're going to take a gain in QQQ just to put the money back into SPY. You don't want to do that, because most likely it would be a short-term game anyway. But sold for 1K or my IRA, for example, I can mess around with those all day long. $47,000 gain, I can sell out of that. Doesn't matter. It's not going to affect me tax-wise, right? Obviously, it's going to hurt me when I try to do Roth conversions, but we'll save that for a different day. So that is one strategy, using JEPI and JEPQ. Obviously, it works for other things, right? I just used 3 different examples there. Let me know if you have any plans of using something like this, or if you ever thought of doing something like this. Well, anyways, let me know what you think down in the comments. We'll see you next video. Thanks for watching.